Hey everyone, welcome back to another dividend investing video. The summer of 2023 has brought a lot of green into our dividend portfolios, with the S&P 500 being up about 18% year to date. And if you're a dividend growth investor like myself still accumulating, it's something of a double-edged sword. But regardless of the markets, I'm adding to my core positions every single week across a few accounts. I don't know if stocks will be up or down in the month of August, but I know if I stick to my plan, more of my hard-earned money will be working for me. My forward income will be higher, and someday, work will become optional for me, at least from a 9 to 5 cents. Finding cheap stocks in this kind of environment is pretty challenging, but I'm more focused on quality businesses that grow their revenues, their free cash flow, and their dividend payments every single year. And I'm happy to acquire businesses like this at a fair value. Today I'm going to review 4 dividend stocks that I have on my buy radar for August 2023. These are companies I'm going to be focused on primarily this month. We have 4 companies to cover, so won't go too deep into any of these, but it's really meant to spur further research, ideas for your watch list for more due diligence. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The first stock I'm buying this month is Waste Management, ticker WM. They are part of the industrial sector in the environmental and facility services industry. They are in the business of, waste management. If you are in the US or Canada, they might even be your local trash company. Based out of Houston, Texas, the company's network includes 346 transfer stations, 293 active landfill disposal sites, 146 recycling plants, and more. Together with Republic Services, Inc., they handle more than half of the garbage collection in the United States, making these two companies something of a duopoly. Year-to-date, shares are up about 2.17%, but shares have been dropping over the last month, down over 6%. Shares are trading right around $160 at the time of publishing. Waste Management has been a wonderful investment over the last decade, something of a compounder, you could say. On a total return basis, you'd be up 374% over the last 10 years, hugely outperforming the S&P 500 over that same time. Now, Waste Management has been beating the market. This is a high-quality company. It trades that way as well. It's not cheap by any means. It's trading at a forward PE of 25.5, slightly below its 5-year average PE of 26.7. Relative to itself, it's around its fair value from this perspective. Now, looking at Waste Management from a dividend yield theory perspective, it's right in line with its 5-year average of 1.75%. And notice this opportunity doesn't really come very often with Waste Management, especially over those last few years. So that's part of why I'm taking this month to beef up my own position in the company, because I'm totally sold on the business for the next 10 years and beyond. Waste Management pays out in the months of March, June, September, and December, paying 70 cents per share for a total annual payout of $2.80. Ex-dividend is going to be around the first of the month. Another good reason I'm going to be increasing my stake in Waste Management in the month of August. The dividend has a forward payout ratio of 44% of forward earnings and 63% of forward free cash flow, gotten a little high as a percentage of free cash flow, but it does look to be an outlier. And Simply Safe Dividends provides a dividend safety score of 74, rated safe. Now, Waste Management has 19 years consecutive dividend raises and 23 without a reduction. The dividend has been growing at a rate of 9% on average every year over the last 5 years. Its latest dividend raise back in December came in just shy of 8%, so they're beating the rate of inflation with their dividend hikes. Waste Management also does the annual share buybacks. We see this nice declining graph, which is what we like to see. The less shares outstanding give your own shares a larger part of the pie, so to speak. Return on invested capital is at 15%. ROIC is stable for this company, and they do a solid job on that front allocating capital. And debt is a little bit on the high side. Net debt to capital is 69%. But notice this isn't unusual. This is just kind of how they run their business. And the average analyst price target is $177.83, so potential 10.85% upside from today's prices. And for me, having the top player in this industry, which is truly vital for society to function, seems like a no-brainer to me. I'm happy to pay fair value for this one. It just doesn't come cheap, ever really. It took a tumble last week after missing earnings, and I'm hoping this continues for a bit. Waste Management they turn your trash into cash. And before we get into this next one, let me know down in the comments, please, what is the number one stock you're focused on in the month of August? I want to hear what you are buying. Let's all share some ideas here. So the next stock I'm increasing my ownership in the month of August is NextEra Energy, ticker NEE. The utility sector has been one of the few losers of 2023, which puts it right in the crosshairs of value-minded investors. And NextEra is one of the best in the breed for that sector. They are an electric utility based out of Florida, serving more than 12 million customers and the largest electric utility by market cap on the market. Shares are down big, 16.38% year to date. At the time of publishing, we are right at that 52-week low, and maybe it goes lower by the time you're watching this. Now, NextEra is another long-term market beater. The last 10 years have brought a total return of 312%, far exceeding the broader market. Not many utility companies do this, but of course, we don't know what the future holds. Now, NextEra Energy is trading at a nice discount to its 5-year PE at 21.9, which is a 22% discount to its 5-year average. NextEra, from a dividend yield theory perspective, looks even more attractive. The 2.7% yield is 26% above its 5-year average. This looks like a uniquely opportune time to load up on my own position here. Historically, it doesn't really often come this cheap. The dividend for NextEra Energy has been paid out in the months of March, June, September, and December, paying 46.75 cents per share for a total annual payout of $1.87. We also have an upcoming ex-dividend date of August 29th for that September 15th dividend. The dividend payout ratio is at 59%, and we want to see this below 75% for utilities. Now, NextEra Energy has plenty of room to keep growing this dividend. Look at that consistency. NextEra Energy features a dividend safety score of very safe from Simply Safe Dividends, getting the highest possible score of 99. NextEra Energy is a dividend aristocrat with 27 consecutive years of dividend growth, and this growth has been coming at a double-digit rate on average over the last 5 years. And its latest raise back in February was at 10%. The average analyst price target is at $89.60, representing almost 30% upside from its current share price. It's not often we see a utility with this much potential upside. Now, in my YouTube dividend portfolio, this has been the sole utility company in that account for now. Now, I don't usually go heavy in this sector, but having some exposure is a good idea. And if you're only going to own one of these companies, NextEra Energy strikes me as an excellent choice. Another stock I'm going to be buying in August is Lockheed Martin, ticker LMT. I was also buying this one in July. I plan to continue in August. Lockheed Martin is in the industrial sector in the aerospace and defense industry. They operate in 4 segments: aeronautics, missiles and fire control, rotary and mission systems, and space. This is a company vital to American national security, as the U.S. government is their primary customer, along with other foreign governments that are contracted via the U.S. government. Now, Lockheed Martin shares are actually down year to date, about 6.5%. Shares are trading right around the midpoint of the 52-week range. Much of that drop has been in the last month. And if you're noticing a pattern here, this one has also crushed the broader market over the last 10 years, with a total return of 375%. Lockheed Martin is trading at a forward PE of 16.4, slightly above its 5-year average, suggesting it's around the fair value by this metric. A dividend yield theory look tells us that Lockheed Martin is reasonably valued as well. Its 2.69% yield is about exactly in line with its 5-year average. Lockheed Martin is on the March, June, September, December dividend payout schedule, and they pay out $3 per share for a total annual payout of $12. We have an ex-dividend coming up on August 31st for the September 22nd payout. The dividend coverage looks healthy, with the Lockheed Martin dividend taking up 44% of forward earnings and 49% of forward free cash flow. We want this to be 60% or lower for companies in this sector. And Simply Safe Dividends provides Lockheed Martin with a safety score of 84, rated very safe. Lockheed has a 20-year dividend growth streak, putting them 5 years away from dividend aristocrat status, which I anticipate they will hit. The 5-year average annual dividend growth rate is 9%, and the latest raise was at 7% announced last September. Lockheed has been steadily increasing its earnings per share and free cash flow per share. The latter is a big factor in why they are able to increase these dividend payments at this above average rate. Now, here's another company doing the heavy annual share buybacks, going from 327 million shares outstanding in 2013. Today, there's 258 million shares outstanding, reducing outstanding shares by more than 21% in the last decade, which is super impressive. The average analyst price target is about $500 per share, representing 12% upside from where we are today. Now, this industry might not be for everyone, but it has its role in our world where human conflict is inevitable. The company is ripe for a stock split, if you ask me, with a share price around $445, and a good thing for fractional shares, because that will allow me to keep building up my position in this wonderful high-quality business. It's not exactly cheap right now, but this is my preferred play in the space, and I'm fine buying this one for a fair price. One more interesting fact, did you know that only 36% of you folks watching this are subscribed to my channel? That's right, 63% of you haven't clicked that subscribe button. And hey, if you've gotten this far, don't you want to stay up to date and get more videos like this? All right, one more stock I'm focused on this month is Altria Group, ticker MO. This is a tobacco company based in Richmond, Virginia. They sell smokable and smokeless tobacco products in the United States, best known for their Marlboro brand. They also have Black & Milds and Copenhagen. They've been in business for more than 200 years. Now, year-to-date shares of Altria Group are down by around 3%, 3.5%. Over the last 10 years, now Mo has underperformed the broader market. It's the only one out of this group to do so, but people buy this one for the dividend income, frankly, and its share price has been largely stagnant for the last 5 years-ish. Now, shares have a total return of 122% over the last 10 years, so if you do zoom out further, however, Mo has more than a 5,000% total return over the last 30 years, and those returns triple the broader market. So a lot of people have made some money on this one. Now, shares of Mo are trading at a PE of 8.7. It's a 13% discount to its 5-year average, making the stock look undervalued today. Mo is available for a screaming high 8.5% yield. This is 12% above the 5-year average, making it undervalued in terms of dividend yield theory. Altria pays out on a January, April, July, October, hey, something different finally, schedule. And they paid 94 cents per share for a total annual payout of $3.76. Now, the ex-dividend will be around mid-September. The next dividend has not been announced yet. It is on track for a raise in this next payment. The dividend payout ratios are looking good for Altria. Check out that consistency of the payout ratio in respect to earnings. That's 74% right now and 78% of forward free cash flow. We just want to see this number below 85% for a tobacco company. And Simply Safe Dividends gives Altria a dividend safety score of 55, borderline safe. And compare that to their peers. They see it a little less safe than Philip Morris International, ticker PM, but more safe than British American Tobacco, ticker BTI. We have more than 53 years of consecutive dividend growth. You can see a cut in this chart, but that is a result of the Philip Morris spinoff of 2008 when they split their domestic and international businesses into two separate companies. The two companies, once they were separated, they ended up paying out a larger dividend than Altria alone had previously. And dividend growth is solid for a high yielder like this. We have a 5-year average annual dividend growth rate of 8%, with the latest raise at 4.5% last year. And as mentioned, we're expecting a new dividend increase announcement pretty soon, sometime this next month. Now, you might be shocked to think that a company like this has managed to grow its earnings and free cash flow over the last decade. But look, free cash flow per share has more than doubled over the last 10 years. We have a return of invested capital of 46%. They constantly smash it on this metric. And the average analyst price target is $49.62, representing 12.77% upside from current prices. Couple that with an 8% yield, that's a potential 20% return over the next year. So like Lockheed Martin, this business isn't going to be for all investors, and if you choose not to invest in companies like this for your own personal reasons, much respect for that. You have your own reasons. Now, I do have a small position myself, and just the other day I did add to it with my Verizon dividends, and I plan to buy some more with my Texas Instruments and AbbVie dividends I'll be getting later in this month. This is an older account that I have. And I'm not really added to it otherwise in the last year. I don't want this to necessarily be a big position, but I do see a place for it. It's one of the fewer higher yielding stocks. Keep growing their dividend at a meaningful rate, and that income comes in and I can buy other stocks with it, or I can buy more of it. So those are the 4 stocks I've been focused on this month. I'd say they are the top 4 I'm focused on for August. Interestingly, they all have ex-dividends coming up in the next 30 to 45 days, and that's always a nice bonus. Of course, I'm going to also be buying SCHD every week as I have been, and I'm also building up my REIT positions. I think those are valued nicely right now, such as Agri Realty, BG Properties, and American Tower. Those are probably my 3 big ones right now. And we're really due for a video on that sector here in a couple weeks too. So be on the lookout for that. And if you do want to see my public dividend growth portfolio, how it's coming along, go ahead and click into this next video. I cover the dividends I received in July 2023, as well as all the stocks I purchased that month in the account. And it's just me trying to demonstrate one way to build a dividend portfolio in real time. This account's going to be about a year old next month. So thanks for sticking around, and until next time, keep investing.